So we have calculated 10% PV of cash inflow. Multiply the expected cash inflow with PV factors. We get PV of cash inflow. The PV of cash inflow total is 2,04,356. So we rounded off to 357. So PV of cash inflow 2,04,357. PV of cash outflow 1,44. Total NPV is 60,357. Now we have to give the conclusion on these two methods, IRR and discounted payback period. IRR method and CE, certainty equivalent coefficient. It is suggested to accept the project because the IRR of 31.53% is greater than the required rate of return. The required rate of return given in the problem is 10%. 10% required rate of return, whereas IRR is 31.53. It's a good project, acceptable. Similarly, applying certainty equivalent coefficient CE factors and then calculating NPV, we got the NPV as 60,357, positive NPV. So both the criteria will favor that this project should be accepted. See the next problem, that is problem number 31. Problem 31. A company is considering a capital investment proposal where two alternatives are being considered. Both investment have a 5-year life. In option 1, a new machine would cost rupees 2,78,000 and option 2 8,50,000. This is the cost of the machines, two machines, option 1, option 2. Both the machines have a life of 5 years and the cost of the first machine 2,78,000 and cost of second machine is 8,50,000. Anticipated scrap value after 5 years are 28,000 and 1,50,000 respectively. 5 साल के बाद जब मशीन को बेचेंगे तो स्क्रैप वैल्यू 28,000 आएगा फर्स्ट ऑप्शन में, और सेकंड ऑप्शन का सैल्वेज वैल्यू 1,50,000. Depreciation provided on straight line method. Option 1 would generate cash inflow of 1 lakh rupees and option 2 will generate a cash inflow of 2,50,000. The cost of capital 15%. Calculate for each option payback period. First question, it is asking you to calculate payback period. Second, ARR, accounting rate of return or average rate of return. Then NPV method and IRR method. So all the 4 methods we have to apply in this problem, right? First of all, payback period. The first question it is asking is calculation of payback period. First you write down problem number 31. A point. Calculation of payback period, PVP. Annual cash inflows are constant. So we calculate PBP by using formula. There are 2 methods of calculating PBP. First, formula method when annual cash inflows are constant. Second, cumulative method when annual cash inflows are not constant. Here it is constant, so we apply the formula. PBP is equal to initial investment divided by constant annual cash inflow. So first, option 1. PVP is equal to 2,78,000 divided by, what is the cost of the project? 2,78,000. 2,78,000 divided by annual cash inflows are constant 1 lakh. So it is 2.78 years. Similarly, option 2. PBP is equal to rupees 8,50,000 divided by rupees 2,50,000 is equal to 3.4 years. Come on. First bit we have completed. It is asking you to calculate PBP and PBP initial investment by constant cash inflow. By using this formula, we have calculated the PBP. Secondly, it is asking you to calculate ARR. Average rate of return, ARR. ARR we calculate. So ARR, the formula for ARR already we know it, average PAT divided by average investment into 100. This is the formula for ARR. Now we know cash inflow is equal to, see here, cash inflow is equal to, no, first of all we calculate annual depreciation. Annual depreciation is equal to cost minus scrap by life. So option 1, depreciation is equal to, what is the cost of the first machine? 2,78,000. And what is the scrap value? 28,000. Divide by life is 5 years. So it will become 50,000. Depreciation is 50,000. Secondly, option 2. Depreciation is equal to cost of the machine 8,50,000 minus scrap value is 1,50,000 divided by 5 is equal to 1,40,000. These are the depreciation on option 1 and option 2. Now one formula is there, cash inflow is equal to PAT minus PAT plus debt. कैश इनफ्लो मालूम करने के लिए, सीएफएटी मालूम करने के लिए पीएटी में डिप्रिसिएशन को ऐड बैक कर लेते हैं. तो पीएटी प्लस डेप इज इक्वल टू कैश इनफ्लो. अगर फॉर एग्जांपल आई नीड पीएटी, सो ब्रिंग दिस डिप्रिसिएशन टू लेफ्ट हैंड साइड, तो कैश इनफ्लो माइनस डेप इज इक्वल टू पीएटी. वी अप्लाई दिस फॉर्मूला टू फाइंड आउट पीएटी. एआरआर एक ही मेथड है जहां पर कैश इनफ्लो नहीं चाहिए. There it requires PAT, it does not require cash inflow. सारे other methods के लिए cash inflow चाहिए, सिर्फ ARR मालूम करने के लिए we need PAT. PAT is not given in the problem. Cash inflows are given. Cash inflows are given. PAT is not given. तो cash inflow मालूम करने के लिए, PAT मालूम करने के लिए cash inflow minus depreciation. तो option 1 PAT is equal to, how much is the cash inflow for option 1? 1 lakh. 1 lakh में से depreciation निकाल देंगे 50,000. So remaining 50,000 rupees is the PAT. Similarly, option 2. PAT is equal to, the annual cash inflow are 2,50,000 minus depreciation 1,40,000. is equal to rupees 1,10,000. So what we got is PAT, annual PAT. Now we calculate annual investment, average investment is equal to 1/2 into cost plus installation minus scrap, close the bracket, plus scrap. So option 1, average investment is equal to 1/2 into, what is the cost of machine 1? Option 1, 2,78,000. That is equal to 1,25,000. 1,25,000 plus 28,000 is equal to 1,53,000. This 1,53,000 is the average investment of option 1. Now option 2. 1/2 into 8,50,000 plus 0 minus 1,50,000 plus 1,50,000. That is equal to 3,50,000. plus 1,50,000 is equal to 5 lakhs. So 5 lakh rupees is the average investment. Now calculation of IRR. ARRs. Calculation of ARR. Option 1. Average PAT. The annual PAT is remaining same. How much is the annual PAT? 50,000. Average investment is 1,53,000 into 100. So it comes to 32.7%. Option 2. The annual PAT is 1,10,000 and average investment is 5 lakh. Into 100. It comes to 22%. That's it. So we have calculated PBP, we have calculated ARR. Now thirdly we have to calculate NPV. Now calculation of NPV. Option 1. So annual cash inflows are constant. So I am making use annuity to save the time. Otherwise we can calculate individually for the 5 years. हर साल cash inflow 1 लाख रुपए constant है. So instead of taking 5 times 1 lakh, 1 lakh, 1 lakh, 1 lakh, I'll take only one time. And here I'll take annuity. So 5 years 10%. 5 years it is not 10%, it is 15%. It is given in the problem 15%. Yes, cost of capital is 15%. So annuity 15%, how to calculate? Already in the previous problems we have seen 15% means 1 divided by 1.15. 1 divided by 1.15 is equal to, we got first year. Put this first year in the memory. 1 year over. We need 5 years. Second year is equal to M. 2 years. 3, 4, 5. 5 times we have put in memory. Now recall your memory. 3.352. Similarly, we are going to get the salvage value at the end of the life of 5 years. 5 साल खत्म होने के बाद जब मशीन बेचेंगे तो we are going to get 28,000. But this 28,000 we are going to get only once. एक ही बार आ रहा है. Only once. That's why we take PV factor. 5th year PV factor will take. 5th year PV factor. 1 divided by 1.15 is equal to, ये first year हो गया, is equal to second year, third year, fourth year, fifth year. 5 times I have pressed. So 0.497. That's all. Now if we multiply 1 lakh into this one, 3,35,200. And this is 13,916. The total is 3,49,116. Now PV of cash inflow 3,49,116 minus PV of cash outflow 2,78,000. So NPV is 71,000. Or first machine completed. Option 1 completed. Now we'll go for option 2. Year, cash inflow, PV factors at the rate of 15%, PV of cash inflow. 1 to 5 years and 5th year. PV of cash inflow. So annually we are getting 2,50,000. And at the end of 5th year we are getting a scrap value of 1,50,000. Annually we are getting 2,50,000 and scrap value we are going to get 1,50,000. Now PV factors are 3.352 and 0.497. Now multiply 8,38,000. 74,550. Total is 9,12,550. So PV of cash inflow minus PV of cash outflow 8,50,000. The NPV is 62,550. That's it. So we have calculated PBP, we have calculated ARR, and we have calculated the NPV. Now the last thing we have to calculate is IRR. Calculation of IRR, internal rate of return. Fake PBP. Is equal to initial investment divided by average cash inflow. So option 1. Average cash inflow is equal to, we are getting 1 lakh rupees for 5 years, plus at the end of the life we are getting 28,000. That is equal to 5,28,000 divided by 5. It comes to 1 lakh into 5. So it comes to 1,05,600. This is the average cash inflow. Now fake PBP. 2,78,000 initial investment divide by 1,05,600. You will get 2.633. Against year 5 at 26%, it is 2.635. We begin our calculations at 26%. One to 5 year, 5th year. One to 5 year, we are getting 1 lakh. 5th year, we are getting 28,000, right? Now, we need PV factors at 26%. 26% means 1 divided by 1.26. 1 divided by 1.26 is equal to, first year, I'll put it in memory, second, third, fourth, fifth. 0.635. Similarly, 1.126, 26%. 1 divided by 1.26 is equal to first year, second year, third year, fourth year, fifth year. 0.315. That's all. Now we multiply 2,63,500. Here it is 28,000 into 0.315. 8820. 2,63,500. 2,72,320. PV of cash outflow is equal to 2,78,000. The difference is very less. We got 2,72,320, whereas actual cash outflow is 2,78,000. So, in order to increase the PV of cash inflow, we decrease the rate. Let the new rate be 24%. 24% से ले लेंगे. तो PV factors at 24% and PV of cash inflow. PV of cash inflow at 24%. 1 divided by 1.24 is equal to first year. I'll put it in memory. Then second year, third year, fourth year, fifth year. 2.74, 2.745. 1 divided by 1.24 is equal to first year, second year, third year, fourth year, fifth year. 0.341. Now we multiply. So 1 lakh into 0.2, so 2,74,500. Here it is 28,000 into 0.341. 9,548 plus 2,74,500. It comes to 2,84,048. At 24%, 2,84,048. At 26%, 2,72,320. Cash outflow is equal to rupees 2,78,000. IRR lies between 24% and 26%. 24 और 26 के बीच में IRR है. %24 plus 2,84,048. Difference 2. $2,84,048 minus 2,78,000. 6048. 2,84,048 minus 272,320. 6048 into 2 divided by 11,728. That's it. 25.03%. This is the IRR of option 1. IRR of option 1, 25.03. Now option 2. Average cash inflow is equal to, so option 2, 25.03. Option 2, average cash inflow, we are getting 2,50,000 into 5 plus 1,50,000 divided by 5. So average cash inflow, we are getting 2,80,000. Fake PBP, 8,50,000 divided by 2,80,000. We are getting 3.036. Now at 19% dash, we are getting 3.058. Nearest factor is at 19%, 3.058. So we begin our calculations at 19%. So same table I am making here. Annual cash inflow 2,50,000 and end of the year we are getting 1,50,000. Same table, but percentages will change. Amounts will change. Now we are taking at 19%. 19%. At 19% we are taking the PV of annuity factor. 1 divided by 1.19 is equal to, first year, I am put it in memory. First year 1, second, third, fourth, fifth. 5 times I have put in memory. Now recall the memory. 3.058. Similarly, fifth year, 1 divided by 1.19 is equal to, first year, second year, third year, fourth year, fifth year. 0.419. Now multiply 2,50,000 into 3.058. 7,64,500. Similarly, 1,50,000 into 0.419. 62,850 plus 7,64,500. 8,27,350. The PV of cash outflow is 8,50,000. PV of cash outflow is 8,50,000. We got 8,27,000. So in order to increase the PV of cash inflow, we have to decrease the rate. We have to decrease the rate. Let us take it as 15%. 15% ले लेंगे. Arbitrarily we'll take it as